Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we count you down to President Trump's tariff announcements as investors prepare for volatility. Plus, we look at the areas of the market where investors could seek some safety and get defensive. And a central bank official warning of a slowdown in consumer spending as tariffs hit prices. All of that and more coming up here on Catalysts. Half an hour into the start of your U.S. trading day. Let's get a check on the markets here. Taking a look at the major averages, you continue to see a little bit of a sell-off this morning. The S&P down about 0.3%. Your tech-heavy NASDAQ off about 0.3%. The options market pricing in a 2 to 3% swing in either direction off the back of those tariff announcements. Again, expected to come at 4 p.m. Eastern today. Let's take a look at what the bond market is doing. We had those strong ADP numbers this morning, and you're seeing yields coming down off the back of that. You've got your 10-year down just about 2 basis points, nearing that 410 level. And we are going to continue to monitor all of the market moves for you throughout the day today. I do want to bring in Chris Versace. He's the Chief Investment Officer and Thematic Strategist at Thematic Research. Chris, great to have you with us. Thanks for being here for the hour. Talk to me about your view on the broader market now. Obviously, we're seeing a little bit of selling heading into today's trade. What are you anticipating?
I don't think the next couple of weeks are going to be all that good for investors. Yeah. I hate to say that, but, yes, today, maybe at 4 p.m. we get some clarity, but then we have to wait from the response from those companies that are slapped with tariffs. I don't think we'll really start to see that picture for several days. And then companies, as they continue to, roll up their books during the quiet period, they're going to have to factor all of this into their guidance for the June quarter. And expectations for the June quarter compared to the March quarter, up 9% for the S&P 500 basket. Pretty aggressive, given, slower consumer spending, high degree of business uncertainty, and tariffs. So I think the March quarter earnings season is going to be a little rough.
So where can investors find safety? Give me a couple of recession-proof stocks investors can look into.
So one of the things that we've been doing is trying to figure out, okay, where is spending going to continue? And what you're asking really, in my view, is what are the inelastic goods and services that people are going to buy no matter what? Yeah. So when we think about that, you can have certain utilities, right? Electric utilities are a great example, or they may not be exactly a utility, but think of our mobile service, right? So an AT&T or Verizon. So, you kind of put those together. You could buy the XLU ETF, right, for utilities. You could talk about maybe Dominion Power, Con Ed. Those are other good plays. And again, companies like a T-Mobile, a Verizon, or an AT&T.
Should investors be staying in U.S. stocks still?
Wow, that is a big question. I think you always kind of have to have a diversified portfolio. I tend to prefer U.S. listed stocks, largely because of the amount of information that we can get, filings with the SEC and the like. Sure. Sometimes you got to be a little more careful, but maybe ADRs are a good way to go, or ETFs for certain country exposure. Right.
And we've seen Chinese tech getting a lot of attention, but one of the questions is how much transparency there is in some of those names.
Correct.
So it's an important thing to bring up. Chris, thank you. You're going to stick with us for the whole hour, but I do want to turn now to more defensive plays amid the tariff uncertainty. For that, we've got Willem Sells. He's the Global Private Banking and Wealth Global Chief Investment Officer over at HSBC. We also have Matt Brill, Senior Portfolio Manager for Fixed Income at Invesco. Thank you both for being here. Willem, I want to start it off with you. You just downgraded U.S. and global equities to neutral. Could policy clarity off the back of today's tariff announcement potentially push you to re-upgrade U.S. stocks?
Well, the question is when we are going to get that clarity, because, of course, yes, the announcement may give us some clarity on those particular measures, but then we need to see whether there will be any reaction from other countries around the world, what they are going to do. Are there a number of those measures? And then, more importantly, what is the impact on the economy? How is the business sector going to react? How are the consumers going to react? They are unclear about how much this is going to lead to slower growth, to higher inflation. Therefore, they take a wait and see attitude. The Fed is also taking a wait and see attitude. So, clarity is not going to come tomorrow.
Willem, come into the conversation here because investors are looking to fixed income as a hedge against all of the uncertainty. Where within treasuries should investors be diversifying?
So sorry.
I'm so sorry, Matt, go ahead. Sorry about that.
Oh, yeah. Within fixed income, we're relatively bullish on overall fixed income. I'd say it's less clear on credit. So Clearly, the administration, has longer-term prospects here of what they're trying to do with corporations. But over the near term, there's this uncertainty is really driving a lot of volatility and a flight to quality, which primarily is going to be found in the U.S. Treasury market. So we think U.S. Treasuries can go lower here. We would stay defensive with investment-grade credit. EM has been an area we've not liked for some time now, but now high yield is now on the selling block a little bit as well. Where high yield is a little more complicated, just because if the overall pie of the U.S. economy is going to shrink here, which it may, high yield would be in a little tougher spot.
Willem, how are you thinking about the June quarter guidance that we're getting as the March quarter earnings season kicks off? I'm a little concerned about it. I think expectations are a little robust relative to all the factors that we've been discussing. What say you?
I would agree with you. So, there have been some downward revisions by analysts, but clearly the stock market has gone much quicker, than analysts. Now that is typical, of course, but we do think that there is potential, for further downgrades of those earnings expectations. We do think that companies will try to kitchen sink to some extent and really, push down, the earnings guidance in the quarter that comes, so that they can then finally have the positive news over the following quarters, and then you can get a rebound in the stock prices as well after that.
So just to follow up, you're not surprised then by some of the S&P 500 price targets we've seen, Barclays, Goldman's. Do you think we're going to see more of that in the coming weeks?
So if you look at, so in the economic data as well as with investors, you see the same thing. You see the confidence that has changed, but in the economic data, you've not yet seen the impact of that changing confidence in the hard activity data. With investors, it's the same thing. They all tell us they are quite cautious, but then if you actually look at their positioning, that is not yet, underweight. The hedge funds, of course, have been acting more rapidly. But whether we look at our clients or investor surveys about actual positioning, they have not yet really gone underweight. So I think, and analysts the same thing. So I don't think you have yet had, the capitulation trade in a certain way that puts the floor under markets. It's only, I think, when you get further adjustments in positioning, further adjustments in PE, that you then get, the very attractive levels that people are going to say, oh, this is a buying opportunity, I want to step in here.
Matt, how might that impact the bond market if we do start to see a little bit more of that dip buying coming in? Where do you see treasuries heading?
Yeah, so if you see dip buying coming in for the equity market, I would think that would be somewhat at the expense of treasuries. Treasuries have benefited over the last several weeks due to this kind of flight to quality, just this fear trade or the slowdown trade, really. So, I think if you do get a capitulation that William's talking about, we would see a large rally in 10-year treasuries and longer dated treasuries. So that would be very good. Again, it's going to come down to credit. It'll be a little more complicated there because if we have a soft recession or even just a slowdown, I think credit has already cheapened up a little bit, so it should be okay. However, if we're going to a hard stop and just all this uncertainty and noise really around the economy, you'd be in a much worse place there. So for now, up in quality, stay in treasuries. But I think there will be a time here that we're going to look to be a little bit more aggressive when risk standpoint. But we haven't had that capitulation yet. And as bad as it feels, it still haven't moved a whole lot from a credit spread standpoint.
And Matt, staying with you, you said that Treasury Secretary Scott Bessent will get rates down with or without a recession. How does he get them down successfully without one?
Yeah, so if you listen to him speak, and he's been on numerous podcasts and the like, and he every single one of them, he says his number one goal is to drive the 10-year Treasury lower. So he looks at that as a scorecard daily. He thinks he's going to save the U.S. Fiscal, the U.S. government money by driving the 10-year Treasury down. So how does he do it? The main thing is going to be around deficit spending. So he needs to get to this. He's got a 3-3-3 goal. One of those threes being 3% deficit spending, and we're at somewhere between 5 and 7%. So tariffs, what they do to the market, we'll have to see here, but they could be a source of revenue. You've also got this, this idea around the golden visa, but then just other expense cuts. And, although a lot of them are not popular, they are, going to move the U.S. towards a more balanced fiscal budget, which will then result in lower 10-year rates. So I think you're going to get lower 10-year rates whether you get a recession or you get kind of a slowdown with deficit spending more in line with tax revenues.
All right, Matt, thank you so much for that overview. Really appreciate it. Also, Willem Sells from HSBC. Thank you both so much for being here. Appreciate it. Chris, I want to go to you on this because it was interesting hearing your questions to Willem specifically just about what we're going to see in this upcoming quarter with regards to earnings and the stock market overall. Any takeaways from you?
Well, he agreed with me, so right. It's always nice to have
Reaffirms the bearish narrative, though.
Challenging narrative, not necessarily bearish, but I do think just overall it's going to be that resetting of expectations, not just for the June quarter, potentially for the back half of the year as well. Typically, earnings expectations are usually, how do we say this, just a little overly robust early in the year for the back half of the year. So I think those will come down. I think the question is how much do they come down? And then what do we think about in terms of what's the right PE? And that'll tell us whether or not the market's fairly valued, overvalued, potentially undervalued.
Right. Certainly a lot of risks to think about here. Chris, thank you so much. We're going to stick with you for the hour here. Well, current projections have Democrat Susan Crawford beating conservative rival Brad Schimmel in the Wisconsin Supreme Court race with about 55% of the vote in. Elon Musk's $20 million cash infusion wasn't enough to win Republicans the race in the most expensive judicial election in U.S. history. The state's highest court will maintain its 4-3 liberal control. This special election became kind of a proxy vote for or against Elon Musk and his work in the federal government as the head of Doge. Musk not only spent big, but also personally campaigned in Wisconsin, taking the stage with a cheese hat on his head and giving out multi-million-dollar checks to voters in the state. Crawford responded to Musk's involvement in her victory speech, saying, quote, "Wisconsin stood up and said loudly that justice does not have a price. Our courts are not for sale." Musk writing in a post on X that he expected to lose, but there is value to losing a piece for a positional gain. So far, in special elections, Democrats have won state legislative seats in Iowa and Pennsylvania, while Republicans were able to retain 2 contested seats in Florida. These offer key insight into voters' mindsets as next year's midterm elections draw nearer. Coming up, we're taking a look at today's trending tickers, tracking Newsmax's moves following its NYSE debut, and Visa looking to win Apple's credit card. That's next on Catalysts. Time for some of today's trending tickers. Scan the QR code that's about to appear on your screen to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. We are looking at Newsmax, DJT, and Visa. First up, Newsmax pulling back after soaring in its public debut on the NYSE earlier this week. The conservative cable news channel opening at $14 per share on Monday, closing at $233 per share on Tuesday, pushing the market cap of the company above $20 billion. Let's get you a check on the percentage move here. This was a 230% surge. Now we are seeing Newsmax moving to the downside, but after a surge like that, it's expected to see a little bit of capitulation, I would think.
I think everybody's shocked at the size of that. I mean, look, I'm all for the IPO market opening. It's going to be good for some of the investment banks, Morgan Stanley, JP Morgan. But a deal like that, where it just rockets out of nowhere, that's very surprising. Fantastic for the people who got in on the deal and were able to trade it, but yeah, it's got to give some back.
And is it a sign that there maybe is a little bit of leftover froth in this market, or is that reading a little bit too much into a one-off meme stock?
I think it's a one-off, and I think the fact that the Trump administration kind of rejiggered what news outlets were allowed in the White House and in the press briefing room, and the fact that they're one of them, and they might benefit from that, I think that's more what we're seeing here, but overdone no matter what.
Right, not necessarily a fundamental story.
As a fundamental person, I could say no.
Yeah, definitely not. All right, well, another story that we are monitoring this morning, DJT, President Trump's social media company, Truth Social, filing papers with the SEC that would allow Trump's trust to sell almost 115 million shares of the stock. That is the entirety of the trust's holdings. As of Tuesday's close, Trump's shares would be worth $2.3 billion. You can see the stock down nearly 8%. And I mean, I guess when you do talk about the fundamentals, this has been a fundamental risk to DJT the entirety of its existence.
100%. I even step back and I think about, their move into ETFs. And I'm just asking myself, okay, so like, what do they bring? What is different this time around? And whether it's, rebuilding America, related themes, or even as they just recently filed for crypto. Right. And yet you see the president warming up to crypto. It's a little hinky, if you ask me.
And they were teaming up with Crypto.com, to your point,
Correct.
to launch those ETFs. I think part of that was also backed by Charles Schwab. Schwab. So there are some partnerships that I think people were potentially excited about with DJT. They were pairing up with non-meme stock related companies.
Yes.
Was that a sign of this becoming a legitimate investment?
We'll say a little more real. But again, you have to look at the competitive landscape in ETFs. It's fierce, right? And there's a handful of firms that have significant assets. So you got to ask yourself, how are they going to differentiate?
Yeah.
That's the question.
Yeah, absolutely. A key question, I think, for any investment as well, to be fair. Well, finally, Visa reportedly offering Apple $100 million to take over the company's credit card. According to the Wall Street Journal, Visa is looking to beat out American Express and unseat MasterCard, offering the large upfront payment that's normally reserved for the biggest card programs. We were talking about this earlier, Chris. You had some great thoughts just on where this makes sense for these companies moving forward. What are you thinking?
Well, I mean, look, this has been telegraphed by Goldman that they're going to get out of this. So, people have been speculating, could it go to Synchrony? Could it go here? The fact that Visa is willing to pay up $100 million to bring it off the MasterCard network is pretty interesting. But from a brand loyalty perspective, a benefit perspective, I think American Express is a much, much better fit. It kind of fits with the customer service angle that Apple is known for that, meshes extremely well with the Amex culture. And I will say, we do own American Express in the Street Pro portfolio.
And then let me ask, while we're talking about it, how are you thinking about financials right now, just given the run-up that we've seen and obviously a little bit of a flight to safety? Do you think there's still more room to run there?
Well, the way I think about it is financials is a lot like technology, right? It's a wide basket.
Sure.
So you really have to be careful what you're talking about. We recently sold out of MasterCard because we were concerned about the issues that the consumer is facing. When Synchrony comes out like they did last week and they say that, we're seeing consumers really pull back, it's impacting our volumes, you have to be a little concerned. But on the flip side, the CoreWeave IPO seems to be working out. We're seeing others file. So from that, I'm still a little more bullish, if you will, on Morgan Stanley, potentially Bank of America. We're also seeing M&A activity start to percolate, and the outlook for the second half of the year, if we get deregulation, could be even better. So that's kind of how I'm playing it.
All right, makes a lot of sense, Chris. Thank you so much for giving us that context. Really appreciate it. Coming up, the majority of American farmers say tariffs will negatively impact their income in 2025. We'll discuss what retaliatory measures could mean for America's heartland next. The lead up to today's tariff policy announcement whipsawing markets in recent weeks as investors attempt to game out the impact of the president's yet-to-be-known trade policies. Here with more on the potential economic impact of the announcement, we have our Fed correspondent, Jennifer Schomburger. Hey, Jennifer.
Good morning, Maddie. Today is the day that Fed officials, consumers, and businesses will finally get clarity on President Trump's tariffs. Businesses have been holding back on hiring and investment because of lack of clarity around the president's policies. Likewise, Fed officials have characterized the outlook for the economy as uncertain because of uncertainty surrounding the president's tariffs, though Fed officials do see higher inflation and lower growth this year. New York Fed President John Williams told me in an interview this week he doesn't see stagflation now, but noted there's definitely a risk of inflation being higher than forecast of 2.8%, which is where inflation stands right now. Williams told me there's the potential for long-lasting effects on inflation from tariffs. Take a listen.
Those, increased costs for American producers, it takes some time for those to get into consumer prices and show up in inflation. So it's definitely a channel that past history teaches us may take a few years to be fully seen in the data.
Meanwhile, Goldman Sachs and JP Morgan have increased their odds for a recession this year on anticipation of larger tariffs. The president has not ruled out the possibility of a recession, saying that Americans could experience short-term pain, while Treasury Secretary Scott Bessent has said there could be an adjustment. Administration officials refute that inflation will result from tariffs, though they admit there could be a one-time adjustment in prices, though they argue this is what's necessary to bring in a new economic era of growth for the United States. The president will make the official announcement at 4 p.m. today in the Rose Garden at the White House after the market closes. Back to you.
Jennifer, thanks so much for bringing us your coverage. Appreciate it. Well, America's farmers are expected to bear the brunt of retaliatory tariffs, with the majority expecting new trade policy will negatively impact their farms' income in the year ahead. That's according to a survey from Purdue. Now, the American Farm Bureau Federation estimating nearly $27 billion worth of U.S. goods will be targeted by retaliatory measures, with significant impacts on soybeans and cotton specifically. Joining us now with more, Michael Langemeyer. He's the director of Purdue University's Center for Commercial Agriculture. Thank you so much for being here, Michael. Just to get a sense, can you kind of operationalize for me, how do tariffs impact farmers and how do they specifically impact their income?
Okay, let me talk a little bit about the Producer Sentiment Index, and then I'll get into the question you have. The Producer Sentiment Index is derived from a monthly survey that takes place mid-month. In October, the index was 115. In November, the index jumped to 145, partially as a result of the election. We reached a peak at 152, and now it's dropped off to 140 using the survey results from mid-March. And so that's where we're at. We did see some reduction here from February to March, and that's primarily due to policy uncertainty, specifically related to tariffs. You asked the question about the negative impact. The 55% think there's going to be a negative impact on their farm income because of the tariffs. That really takes the form of reduced prices and higher costs, and so it really affects both of those. Certainly when you have goods like soybeans and wheat that are heavily dependent on tariffs, it's probably going to see a reduction in exports of those commodities, and so it's going to have a negative impact on the price. And then also there is items that we import to produce crops and livestock, and those input costs are going to increase as a result of the tariffs. And so as a result, you see a margin squeeze coming from both reduced prices and higher input costs.
And I know in the survey data, farmers are indicating that they're anticipating some sort of rebate or kind of sweetener that allows them to stomach the pain of tariffs. What if that doesn't come to fruition? What is that impact potentially going to be?
If that doesn't come to fruition, 2025 is going to be a very rough year for net farm income, particularly for crop producers. Livestock producers, specifically beef producers, have pretty good domestic market right now, and so the prices are pretty strong in a lot of livestock commodities, but that's not true with corn, soybeans, and wheat and cotton. And so if we don't get some payments related to the tariffs, and the tariffs actually do take place and stay in place for a while, you're going to see a rather large negative impact on net farm income for crop producers.
Now, Michael, you just mentioned that the survey is conducted mid-month, but here we are, at the end of the month, at the start of the new month, and today we will find out, more about tariffs. So I guess my question is that $27 billion that you mentioned, is there upside to that number that we should be thinking about?
It's really uncertain right now, and so it's very difficult to come up with those estimates. And it really depends on how big the tariffs are and how widespread those tariffs are. Whether that $27 billion will be should be larger or whether it should be smaller. So there's just a lot of uncertainties right now, and that's creating some angst, definitely some anxiety in production agriculture.
And Michael, stay with us, but I actually want to ask Chris a question really quickly, because Chris, Michael's making it very clear that there is an inflationary impact to tariffs. There's also an economic one when it comes to labor, the income for these farmers. The president was elected in part due to his promise that he was going to combat inflation. If we start to see so much inflation happening, what does that do not only for constituents who are hoping to see a lowered impact of inflation, but also to financial markets?
It probably says that the Fed is not going to deliver any rate cuts this year, if we see this inflation continue to step up, because we've already seen it, and we're already starting to see Fed officials like Bostic start to back down from the Fed's updated set of projections calling for 2 rate cuts, right? Bostic is now 1. My personal bet is that we won't have any idea until we get to the June policy meeting if we will get any cuts this year.
Right, and that's something that is antithetical to what we're seeing from the market now pricing in 3 rate cuts this year.
So it's predicated on the economy falling apart. Right. But so far, just look at today, right? We get the March ADP employment report, 155,000 jobs created, right? Both manufacturing and services side. more than double what we got in February.
Yeah.
So I don't see how Powell on Friday delivers any kind of, maybe we'll see some rate cuts.
Maybe we'll see some rate cuts. Yeah, that is a key question for Powell on Friday. Michael, I want to bring you back into the conversation here. What do you think the single biggest message is from farmers to this administration about tariffs right now?
If we do have the tariffs, it's going to be necessary to have payments similar to what we saw in 2019 if you're not going to have a very negative impact on farm income. And getting to the inflation, the interest rate, we've done some survey questions related to what they expect to happen to the prime interest rate, what they expect to happen to inflation, and it was very noticeable here in the March survey that they expect inflation to increase, which is going to have upward pressure on input costs and agriculture, specifically, specific inputs, but also they're less convinced that we're going to have interest rate deductions, and so that's also not positive because agriculture is a very capital intensive business, and they were looking forward to some interest rate cuts.
So, Michael, to the extent that farmer income is under pressure as a result of what develops, there's a great relationship between farmer income and replacing equipment. So, from a company perspective, whether it's John Deere, AGCO, are there other companies out there that could be vulnerable?
Definitely, any company related to making capital investments. So equipment is certainly a large one there, but I think also agriculture banks. If income is a little bit tighter, it's going to be difficult for some people to repay term debt. Debt that they've incurred on land and machinery, and so I think also that industry is going to see a more financial stress than we would have seen otherwise.
All right, Michael, we got to leave it there. Thank you so much for joining us. Appreciate it. Coming up, how today's tariff announcement could impact consumer spending in the weeks to come. More on Catalyst when we come back. Chicago Fed President Austin Goolsbee warning in an interview on Fox News that a tariff-fueled rise in prices could lead to a pullback in consumer spending, which could be, quote, a bit of a mess. Recent data already showing consumers pulling back on spending as inflation is still sticky. We want to dive into what this means for the consumer discretionary space. And for that, we have Oliver Chen, a senior research analyst over at TD Cowen. And of course, Chris Versace is still with me. Oliver, thank you so much for being here. How are you modeling what the impact of these tariffs could be in terms of the consumer pullback? Because we've seen this kind of dynamic playing out since the pandemic where consumer sentiment can fall off a cliff, but spending remains. So how might the concern about tariffs bubbling up right now actually impact the dollars being spent by consumers moving forward?
Yeah, Madison and Chris, we're increasingly worried because consumer discretionary trends have been bumpy, and they've been flat to negative in terms of department stores and more discretionary retailers, such as Target. So there's concerns there already. What we see thematically is a lot of bifurcation, meaning much more pressure at the middle and low end. I'm just on the road with Kohl's CEO and lots of discussion around this mixed bag on the consumer. In many categories, the consumers will have a difficult time digesting higher prices. So what we're recommending today in terms of stocks are ideas like Walmart, Costco, BJ's. BJ's is our best idea this year. Walmart was our best idea last year. And consumers will look for value and seek everyday low prices, as well as this club warehouse model. So the biggest worry here is consumer confidence. And the other part of this is this bifurcation where the middle and lower income customer is already under pressure now currently because food prices over time sequentially have gone up, and we've seen a lot of volatility in egg prices already. And don't forget about energy prices as well as interest rates. So we're getting increasingly more worried.
Yeah, it's interesting when you bring up Walmart. It was the stock that was keeping the S&P 500 sort of near the flat line this morning, and now we've obviously seen it tipping into negative here. I am curious if you can talk about what we're hearing from Walmart in terms of their negotiations with their Chinese suppliers to try and keep prices down. Do you think they're well positioned to be successful in those negotiations?
Walmart has a long history of really pioneering everyday low price EDLP. So they've had dialogues with their suppliers constantly. They also have a program called rollbacks where they offer the best price possible and constant negotiations and asking a lot of suppliers to stick to lower prices, which has been essential in this environment. I think thematically, bigger is better. So being and owning a stock where the retailer has more bargaining leverage is very important. And this is a company that does a really precise job running the supply chain. That's true at Costco as well. And Costco is a place where you pay to shop, but it also has a fixed merchandise margin. So you can't get a better deal on many of the products that Costco offers, which is about 3,500 items only. That's a company that's well positioned too. And as we think about Walmart, there's a big technology component as well, including digital advertising, artificial intelligence, marketplace models. I teach a class at Columbia, and retail media is important. So at Walmart, you get a nice defensive grocery business, plus you get technology and a marketplace, which enables a lot of nice growth.
So Oliver, I noticed that you were talking about food prices. I know that consumers are feeling the pain. We're all feeling that pain, candidly. But when we think about Walmart, nation's largest grocery store, when we think about Costco and how they have really leaned into food and fresh foods over the last several years, how is it that BJ's is your top pick? What really helps them stand out against that backdrop?
Yeah, Chris, as we look at these stocks, those are all three in my top five, but the BJ's price to earnings multiple is 26 times. You see Costco at 45 to 50 times and Walmart in the 20 to 27 times. So really the valuation of BJ's being at that PE about half of Costco is quite attractive. And as we think about BJ's, they have a smaller store base. 250 stores, and you think about Sam's and Costco, they're at 500 plus. So BJ's entering new markets, growth prospects. Also, BJ's can improve their general merchandise. As we know, Costco has a legendary brand, Kirkland. BJ's can improve their general merchandise, get better toys. They're doing a lot of category management too, and they have a lot of initiatives around fresh and digital. So we spent a day with them recently, and we're excited about all of those growth opportunities, as well as the price of the stock. We also think many in this warehouse club space can win. Costco, as well as BJ's and Sam's Club, have a place as they can gain share against traditional grocery as well as dollar stores, and that's happening. This has been a steady channel, and it's been a channel that does have higher household income customers too.
Oliver, how should investors think about longer-term growth plays in this environment? And I want to ask you that through the context of some of what I like to think of as like the girly pop stocks that thrive when women are noticing that they have good clothes. So Gap, for example, has become sort of the new Abercrombie and Fitch. I know you cover American Eagle as well. How much staying power do those stocks have, relying on trends versus kind of the potential impact of a negative macro backdrop?
Yeah, what's nice, Madison, that we are in a wardrobe refresh cycle. So apparel's been stronger as people go out again. We've seen mixed signals in beauty as well. And then athletic leisure has good long-term trends. But apparel is pretty challenging to stay culturally relevant and stay ahead of trends and reinstate what's happening. We're still seeing quiet luxury. We're seeing some conservatism in the way people dress. But what we're hoping for is a lot more expression in the spring. And at the high end of the pinnacle luxury goods, there's been a lot of fashion changes, which could be great for creative and bringing people out again. This is going to be partially offset by what we see with the market happening and this teetering nature of consumer confidence. But as you think about Gap and Eagle and others, we're also in a nice nostalgia moment where 90s, thinking about classics. We like Levi's as well. Classics with a twist, personalization with a twist is what's happening in apparel too. We're excited, but apparel is a tough margin industry, particularly as the competition from Shein and Temu is also relevant. So somewhat bifurcated. I think the bottom line in apparel, you have some winners and losers, and relevance is very challenging to maintain over a longer term horizon, but definitely see some winners too. We like Revolve as well, which has done a great job with digital execution.
Oliver, if we game this out and there is, the consumer pulls back, there is retail pain, particularly in apparel, Does that set up a potential positive tailwind in the second half of the year or even the summer for companies like TJX or Ross Stores that will buy, inventory on the cheap and kind of help, the schlep to shop or the treasure hunt experience?
Yeah, Chris, that channel has been enduring. So off prices showed long-term global growth. And the message there is consumers love 20 to 40% off. Those stores did not need to change. That treasure hunt works. That treasure hunt and that perspective with those stocks tends to work in good times and bad times. And we're in this really mixed environment where it could go both ways. So we'll see. Regarding this cautious environment, it's been less favorable for department stores, such as Macy's, such as Kohl's. And it's been more favorable for these value-orientated retailers, as you mentioned, the off-price sector, as you mentioned, and also like apparel at companies like Costco and apparel at companies like BJ's as well. So we'll continue to watch it. It's going to be interesting to think about Q4 and holiday, but a lot of time between now and then. Plus, the information keeps changing. It's been very difficult for companies to plan when they're really not sure when major changes are happening hourly in terms of supplier base. Bottom line, just to keep retail simple, is matching supply and demand. This supply side and the tariffs is adding a ton of volatility as companies think about how to plan inventories, how to buy. And some companies have to plan as much of the year in advance. So all considerations with noise. The bigger consideration for consumer retail companies is actually how much money consumers will have to spend, and will inflation really impact the budgets of the consumer, particularly the middle and the low end customer.
And Oliver, actually super quickly, we got about 30 seconds left. There's been this idea about the wealth effect that if we do see stocks going down, that's going to impact consumer spending. Do you see that at all?
We're seeing cross signals. The U.S. has been stronger in luxury. So we upgraded Richemont, which owns Cartier, wearing a lot of Cartier today. We're still seeing pretty robust local demand in the U.S. and also like not enough supply for Cartier bracelets and Van Cleef. So, but it's certainly mathematically a high correlation between wealth effect and high-end spending. So selectivity and luxury too. Our two ideas there are Richemont and LVMH. At Richemont, this company is doing a great job executing in quiet luxury with respect to jewelry. So that's working. But certainly confidence is something that we're watching, and it's important to be selective in luxury too.
Oliver, I love talking to you because you give us so much insight into the names that our investor audience care about. Thank you so much. Appreciate it.
My pleasure. Good to see you both.
Taking a look at the biggest flows in ETFs the first quarter, what it tells us about where the market's heading. That's next. According to Strategas data, in the first quarter, investors flocked to cash like bonds, commodities, and European ETFs while remaining shy of sectors including energy, the S&P's top performer year to date. For more on what these trends tell us about the broader market, I want to bring in Ben Slavin. He's BNY Mellon Global's head of ETFs for this week's ETF report, sponsored by Invesco QQQ. Ben, thank you so much for being here. Talk to me about how risk-off these flows seem to you for Q1, because we had a lot of inflows into, again, cash like bonds, gold, even European equities, a lot of outflows into even the likes of tech. What does that tell you?
Well, ETF inflows have been on fire for the last several quarters, but here we see a change in terms of investor sentiment. Clearly, the top three categories are a marked difference from where we've been, certainly in 2024. Ultra short-term cash, gold, and Europe, these were not things on the leaderboard, and not surprising given where equity markets have been choppy. Gold has surged past 3,000, and you're seeing Europe really outperform US for the first time in a long time.
In a long time. And I wonder to what extent one of these areas is important for investors to watch as we do head into the second quarter and 2Q earnings as well. Which ETF should investors be looking at as a risk-on, risk-off indicator of how the market is feeling?
Well, you're seeing obviously an incredible amount of ETFs to choose from out there, certainly passive and active. And what we are seeing is a preference, especially in the last couple years, towards active. And what you're seeing is About 9% of the assets and now roughly 40% of the flow year to date has gone into active. And so you're seeing not just investors positioning tactically, but also looking for some kind of professional management in a wide variety of categories, including fixed income and equities in this market.
So when we look at all the uncertainty that's been in the market, the performance, in the first quarter, we obviously down across the board, more uncertainty ahead, tariffs, people are concerned like myself about the June quarter earnings season. Are you seeing folks move assets into some of these inverse ETFs, whether it's the S&P 500, SH or PSQ for the NASDAQ composite?
Yeah, it's really a smaller slice of the ETF market, as you know, given the whole market in terms of its size. But it does give you an indication about what investors are thinking, right. And it's clearly a bellwether there. So not surprisingly, what have we seen? We've seen a positive trend towards more flow going to the inverse or short ETFs. And you're starting to see some cooling in terms of flows into the leveraged or the long side products. And so again, it's all part of this trend of how investors are sort of leaning more towards that risk off, and especially given the uncertainty, it just all kind of adds up to the same picture that you're seeing with investors.
How are you seeing risk on, risk off sentiment play out in Bitcoin ETF flows?
Same, it's kind of a similar sentiment, although it is interesting to note on what's happening with Bitcoin. I mean, obviously, investors are aware of the price action, what we've seen the last, few months. However, it actually is a testament to the ETF wrapper because you've seen positive inflows. So right. You still, on a quarterly basis, saw net positive, nothing like we saw last year, not surprisingly, but still $1 billion plus into the category. And that's really has to do more with the structural shift and the preference towards ETFs versus really sort of an indication of investor sentiment. We kind of see what's going on in the market.
All right, Ben, thank you so much. Really appreciate you joining us on set to break that down for us. And also want to thank Chris Versace for joining me for the hour to guest host. Really appreciate your insights today as well. Thank you so much. Really quickly, I want to do a quick check on the markets here. You're still seeing selling ahead of the announcements on tariffs heading out here. I do want to mention we are seeing a bump up in bond yields, ticking higher on planned EU emergency tariff measures. The European Union saying that they have plans to retaliate against the United States. The EU preparing a package of potential emergency measures to support parts of its economy that could be hit hard by tariffs. That's according to reporting from Bloomberg, and we are seeing that reporting moving the bond market and moving yields higher this morning. Coming up, we've got Wealth dedicated to all your personal finance needs. Julie Hyman has you for the next hour. Stay tuned.